The Indian rupee slid to a record low of rupees 92.92 against the US dollar, pressured by a mix of global and domestic factors, including to a strengthening dollar, rising crude oil prices, and sustained foreign fund outflows. Since the start of Iran-U.S. war, rupee has been weakening against the US dollar. Crude oil prices surged to nearly $103 per barrel after attacks on key energy infrastructure in the Gulf before easing slightly on Friday. In response, major European nations and Japan have expressed willingness to support efforts to ensure safe passage of vessels through the Strait of Hormuz, while the United States has outlined measures to boost the supply. Now, pressure on the rupee is expected to persist in the near term as rising oil prices have triggered significant foreign outflows, with investors pulling around 8 billion from Indian equities so far in March, marking the highest monthly outflows since January 2025. For more on this, I'm joined by my colleague Karthik Malhotra, who joins us as of now. Karthik, this particular aspect of the rupee sliding, it has been consistent with the last 3-4 weeks. We've seen how the pressure from the crude oil factor, the pricing events are there, the outflow from the foreign investors in the country. Where do you think the rupee is now going to land at? Are we going to breach the 93 mark?
I mean, see, intraday in early trading today, Verghese, the Indian rupee, in fact, did breach that 93 per dollar mark. In fact, it went as high as 93.3 before settling down slightly at about 92.2 level, 92.9 levels as we speak right now. So obviously, there is pressure on the Indian rupee, and understandably so, for all the factors that you've mentioned, including the fact that energy prices are on the rise. So Brent crude, for example, had touched as high as about $119 per barrel again yesterday before sliding down to levels of about $102 per barrel. But the interesting story really is that perhaps the Brent crude oil is not the right barometer to look at as far as India's cost of buying energy goes. And some estimates suggest that the price of barrels coming in from countries like UAE are even higher at about $120, $125 per barrel. So when you average out the actual cost that India is shelling out to procure those energy requirements, then we are much higher than the average Brent crude oil price. So we are actually buying oil at nothing less than about $120 per barrel, and that obviously is something which is leading to this forex outflow as far as the INR is concerned. So we are obviously buying more dollars by selling rupees, and that is adding pressure on the Indian rupee. And then, of course, add to that the second part that you mentioned about the FII exodus. Again, that's something which, which analysts out there are making it hard to sort of pinpoint how long that's going to last, simply because it's not that the trend is very clear that money which is exiting India is actually going into US government securities. That's not really the trend, because even the dollar index is under pressure. It is trading at levels below 100, which means that investors right now are preferring, it seems, to sit on cash. They are not liking the volatility. They are not liking the uncertainty around the fact that how long is this war in West Asia going to last, and hence really not being in a position to hedge, either in the equity markets or in the bond market or in gold for that matter. And that is the reason you're not even seeing gold prices spike the way one would have expected them to spike. So it seems that investors are sitting on cash, and India's sort of energy dependence is compelling India to buy more dollars and further weakening the Indian rupee.
Well, compared to other Asian currencies, how do you think India is now faring with its rupee? Of course, even in our South Asian background, we do have several of the neighboring economies also struggling with their currencies.
You're right. I think, it is pretty much a universal problem right now, not just for India, because every country in South Asia does import energy from the Middle East. And the problem really is that every time you want to buy those barrels of oil, you are converting your capital account into a foreign currency called the US dollar. So the demand for the dollar is high, and that is impacting all Asian currencies in equal measure. So, I mean, of course, the Indian rupee also continues to be more volatile, because we haven't seen seen the kind of intervention by the central bank, barring just one instance in the early days of the war, where the RBI did try to arrest the fall of the rupee. Well, some currency managers out there are also looking at potential further monetary policy intervention by the Reserve Bank of India, some open market operations by which the RBI may decide to contain further slip of the rupee. But again, one doesn't really know how long this war is going to last, and would it make sense for India to deplete its forex holdings, which are at about $700 billion or so, just to contain the rupee from sliding another, another 1 rupee or two against the US dollar? One really doesn't have an answer for that. One would sort of, assume that the situation is not that grave as yet, because even though there are these doomsday predictions coming around oil reaching maybe $180 a barrel, which is what Saudi Arabia is saying. Iran has warned that oil could reach about $200 per barrel. If those figures were to come true, then obviously there is going to be, further pressure on the Reserve Bank of India to try and conduct more aggressive open market operations to arrest the, the sharper fall of the rupee expected. But for all you know, as, Israeli Prime Minister Benjamin Netanyahu has said that the nuclear facilities and the ballistic missile program of Iran has been decapacitated. Donald Trump has also hinted that this isn't going to be a forever war, and maybe it is going to end sooner than many people expect. There is a possibility that we may not actually see the kind of doomsday predictions of $180 or $200 a barrel happening anytime soon, and the rupee's fall may eventually get arrested.
When we look at the dollar and how it has been strengthening, there's a lot of confusing contradictions that are happening. A lot of oil is coming into the system. The dollar is also being purchased on a lot of efforts to keep it going. And at the same time, gold prices is also in a very difficult situation when it comes to people not hedging much on it as such. But China is out there to buy most of the gold there. What is happening with the metals, and how is the currency market reacting to that as well?
Right. So, I think there are two or three conflicting views which you just mentioned, and I think we'll take them separately. First, let's talk about the US dollar. Now, in the case of the US dollar, it has had a history of breaching that dollar index at levels of 108, 109 as well, in the not too distant past. But if you look at the present status of the dollar index, which pretty much tells investors how strong that currency is right now, the dollar index is trading at levels below 100. Which means that investors are not all that bullish on government securities in the US. You aren't seeing the kind of shift from equities into bonds happening just as yet, because again, the bond market is fairly complex, Verghese. Investors are concerned about inflation, and anytime you move your money from equities into bonds, there are chances that in a high inflationary scenario, you're not going to get the kind of yields that you would have otherwise expected to get. So there isn't as much momentum, as much bullish momentum on investing, institutional money in US government securities. But countries across the board are obviously trading higher prices on the oil barrel and using dollars to pay for that. So there is a very need-based demand for the US dollar. The US dollar is not really being used as a hedge right now. The US GSEC is not being used as a hedge against equities, and hence you're seeing that the dollar index is not strengthening as much as it potentially could have had it not been a high inflationary scenario. Because remember, even the US Federal Reserve has kept interest rates unchanged with the expectation that inflation could trickle in, and the economy could potentially lose its growth momentum. Meanwhile, gold, of course, happens to be another sort of interesting story panning out. You aren't seeing the kind of panic buying in gold, because gold, if you remember, has, in any case, all of 2025 really skyrocketed to extremely elevated levels. So investors are a little jittery really participating in the metal story at such high prices already. So gold is not being used as a hedge. The second reason why some investors are preferring not to invest in gold right now is that there is uncertainty over physical allocation of gold, because remember, Dubai happens to be, and the UAE as a country and Dubai as a city happens to be, one of the strongest sort of holdings of gold. So with this sort of, shipments being restricted, the Strait of Hormuz continuing to be blocked, investors are not really participating in the gold story, because they really don't know, even if they were to invest in gold right now, the paper value of gold is likely to rise, and that hedge is likely to pay them dividends. But how long before they are actually able to repatriate the physical gold is something that a large question mark looms over, Verghese.